start of 2020, we published our Market Watch, our outlook for the year, called A Tale of Three Cycles. The idea was that investors tried to gauge where we are in the cycle and maybe increase or decrease their risk allocations. Now, we thought cycle models were in danger of being backward-looking and not very reliable for market timing. So we looked at three different types of cycles. We looked at the business cycle, the economy, how hot or cold is it, how close might we be to overheating. We looked at the credit cycle. This is the amount of private debt in the system. This tells us how vulnerable the financial system is. And then we looked at the market cycle, which is the level of valuations and flows into the market. How hot or cold is the market? It gives an idea of what returns we might be able to expect. Now, these are not timing models. They're subjective temperature measures of how hot or cold the various cycles are. Well, the start of the year was definitely warm in the US. We had very strong job growth, very profitable corporate sector, but inflation hadn't picked up yet. So it was warm, but not too warm. In Europe, lower growth, lower inflation, probably lukewarm. In China, slowing down growth, still very high, but lukewarm by their standards as they face off a trade war. Where are we now in the business cycle? Well, it's safe to say the lockdown, the virus lockdown, has pretty much killed the business cycle stone cold. Well, this is a very important one. Past 2008, when there was so much debt in the system, there were many, many years of austerity working down the debt. And we got our personal debt levels down, we got our bank debt levels down. Now this means there's much less chance of a financial crisis emerging because debt levels are that much lower. There are some places where debt levels are high, but importantly, central banks have come in and bought up and secured as much of this debt as possible, so the chances of a financial crisis are much lower this time. Well, this is our concern at the start of the year. The US stock market was very expensive. Europe less so, but still expensive. The bear market took US stocks from very expensive down to about average valuations. It took Europe and China from a bit above average to a bit below average. Then we had the recovery. The US has gone from average valuations to expensive again. Europe and China have gone from below average to average-ish. Normally out of a recession, the recovery sees very strong returns. When you start from a higher valuation like today, those returns will be a bit lower than normal. But importantly, if you're going to compare that with bond or cash returns, stocks are still very much a favourite asset.